with the news in June 2023 that both Ford and now GM will integrate Tesla's NACS charging plug standard into their cars by 2025. The charging standard used by most other EV manufacturers in the United States, the CCS standard, is essentially guaranteed to die out in the USA. The only question is how long it'll take for that transition to occur. It's an inevitability due to the combination of Tesla, GM, and Ford making up around 72% of new EV sales in the United States as of last quarter. The only reason the standard will survive for now is because the United States government essentially subsidizing its survival. The White House has come out saying that only charging networks that offer both the CCS and NACS connections will be eligible for the government's $7.5 billion funding program. The minimum requirement right now is that a charging station offers the CCS standard. Now, regardless, when the news about GM and Ford first broke, we saw EV charging stocks get hit pretty hard, only for many of them to recover due to the announcement that the non-Tesla charging station operators would incorporate NACS compatibility into their sites as well. The vast majority of the large charging station operators, including ChargePoint, EVgo, and Blink, voiced their support for the NACS standard. In this video, we'll discuss what this news means for these charging station companies and if the stock market overreacted to this news. So starting off, a unified standard was inevitable. The last thing consumers want to deal with is several different adapters, and if they forget an adapter, then they end up stranded somewhere because they ran out of charge, not knowing if a particular charger has a compatible connector with your car or not. No one wants to deal with these things. So there was going to be a dominant standard at some point. And it's worth noting that there are a variety of EV charging standards throughout the world. Tesla themselves use the NACS standard in the United States, but in Europe they use the CCS standard and the GB/T standard in China. So this is not to say that the NACS standard will dominate the world, but it will be a leader in the US at the very least moving forward. Now in the United States specifically, the battle for dominance was mainly between the Combined Charging Standard, or CCS standard, and the North American Charging Standard, or NACS. To bring some additional context as to why Tesla likely won this debate, we need to look at the different charging speeds. Charging speeds are currently separated into 3 different levels. Level 1, which is 120 volts, will get you around 5 miles of range per hour of charge. A small amount for getting some extra charge overnight, essentially. At this level of electrical current, you can typically just plug into any house outlet. Level 2 is 240 volts, and this will get you 25 miles of range per hour of charge. These are most of the charging stations you see outside of shopping malls or restaurants. You can have them in your home as well if you use an outlet plug designed for a dryer. Both levels 1 and 2 will use either the J1772 connector, which is used for all non-Tesla EVs currently, or Tesla has the NACS connector. The last level, Level 3, was where this standards battle was being waged. Level 3 is known as DC fast charging, or in Tesla's case, supercharging, and this is a 400 volt charge. This charging option is only available at public charging stations and will get you about 250 miles of range per hour of charge. Most EVs can charge up 3/4 of the way to full, with about 30 minutes charge at one of these stations. And most EVs outside of Tesla use the CCS charging standard at these level 3 charging stations, and that was until Ford and GM announced they'll use the NACS. Now, the reason why EV charging stocks went down on this news, at least initially, was because many of these companies are focused on building level 2 chargers, which use the J1772 connector. And the level 3 charging stations these companies do operate are mostly on the CCS standard. So all these companies would potentially lose business in the future if they didn't put up money to add the NACS connections to their stations. Now, will the NACS being the standard kill EV charging stocks? It's doubtful. Will this raise costs even more for companies that aren't particularly profitable to begin with? Most definitely. And I'm talking about gross margins, because most of these companies are not even close to being profitable. If we take a look at some of the largest public EV charging companies like ChargePoint or EVgo, these companies either have negative gross margins or pretty mediocre margins at around 20%, which is better than the razor-thin margins that you'll see at gas stations, but it's still not great. Now, the CEO of Blink, another EV charging company, was quoted saying this about needing to add NACS connectors to their stations. End quote. "We're not daunted by this, we're simply going to add a Tesla cable. This is not some big, gigantic science experiment." Unquote. So this isn't the death of all EV charging stocks, but the fact of the matter is, this is another expense these companies don't need. Now, luckily, the NACS standard was open sourced by Tesla, so none of these charging companies or the EV manufacturers need to pay royalties. But retrofitting these connectors onto existing charging stations and adding them to new ones is not exactly cheap. Now, the ultimate issue I have with investing in EV charging companies is which one do you choose? Owning a company that just builds the charge ports instead of operating them like ChargePoint might be better, but at the end of the day, none of these companies have stellar margins. Some operators offering subscriptions and subsidies from the government will help. This whole industry is going to be commoditized. No one has loyalty to a particular type of gas station. They'll just go to whichever one has the lowest costs. Or in the case of EV charging, maybe which ones are the fastest or fit their needs at the time. And this inevitably leads to a high level of competition and low margins. Looking at the balance sheet of ChargePoint, an industry leader in charging stations behind Tesla, as of April 30th, they had $283 million in cash and cash equivalents, while losing $80 million last quarter alone. And with EVgo, it's the same thing. Last quarter they had $163 million in cash and cash equivalents, while losing $49 million in total, especially thanks to their just barely scraping by with a tiny gross profit to begin with. If EV adoption is slow, especially during the next 1 to 2 years with a poor economic environment, these companies are going to continue burning cash and continuously diluting shareholders. And taking on debt is an option, not ideal of course, but that's even questionable as well, with liquidity starting to tighten. The bottom line is, it seems like Tesla's NACS standard will become the default in North America over time. But who knows? In a rapidly evolving industry like this, we could see another swap happen as well. And then these EV charging companies will have to spend even more money adding those connectors. The whole industry is commoditized. It's a constant competition between many players and who can offer the lowest prices. So this ensures that gross and ultimately profit margins will always remain low, especially because it's a capital intensive to build, operate, and maintain these stations to begin with. I just don't see these companies being worth the risk, especially in a poor economic environment.